I'm worried that what we're seeing with the euro currency is signaling not just a recession, but perhaps a systemic banking crisis, perhaps capital exiting Europe, concerned that the politicians may respond with something that we haven't seen for a number of years, but it was on the periphery before, and that includes capital controls, as we saw in Iceland, Cyprus, and Greece, but this time, possibly to the heart and core of Europe.
It is now my pleasure to introduce Emil Kalinowski, who is the host of the Eurodollar University show and also a chartered financial analyst. It's good to see you, Emil. Welcome to the show.
Andreas, it's a pleasure. Thank you for having me on. It's great to meet you. I've seen so many of your shows. This will be great.
It will be great. And we're obviously here to talk about Europe today. So why don't we start with sort of a live assessment of the ongoing crisis in Europe? What do you make of the current market turmoil that we see across European markets?
Andreas, I think that most people are looking at it as commensurate with a downturn, a regular recession that's coming to Europe, perhaps because of energy prices, which we'll talk about. But I think it might be something more. We'll see if it turns out that way or not. But I suggest that we keep our eye out for a phase transition in this, what I like to call a silent depression that we've been in since 2008, this period of low economic growth since the global financial crisis, where we've had numerous recessions since then. In Europe, I believe this will be number 5. I think how many have we been in? 3, 1, 2, 3, 4. This might be the one that's coming up right now. And so I'm worried that what we're seeing with the euro currency is signaling not just a recession, but perhaps a systemic banking crisis, perhaps capital exiting Europe, concerned that the politicians may respond with something that we haven't seen for a number of years, but it was on the periphery before, and that includes capital controls, as we saw in Iceland, Cyprus, and Greece, but this time, possibly to the heart and core of Europe. I know it sounds extreme, but just wanted to bring it up, and then we'll see how events unfold over the coming months and quarters.
Do you already see signs of capital exiting the Eurozone in various markets? What's your sort of assessment of the ongoing capital flows right now?
I would just have to point to the dollar exchange rate and the euro, and that would be my signal as to whether or not there's something happening that's more unsettling than your regular old downturn. So that is my indicator right now. What do you think, Andreas? Have you seen anything?
Well, I think you're absolutely right that the development in the euro exchange rate is sort of a bellwether of the ongoing capital flows out of the eurozone. So for now, it's obviously more or less one-way traffic as a consequence of the ongoing energy crisis. But speaking of that energy crisis, Emil, I know that you look at metals and commodities as well. How big of a deal is it?
Yeah, no, I think it's a big geopolitical deal, as our viewers know, obviously. And it's an economic and socioeconomic crisis and political crisis that may develop, likely will develop, that has already been raised a number of times in Europe in the financial media by politicians in the winter ahead. I know that you were just writing about this, that you've got a piece, so we can talk about the energy outlook and what the market says, but let me give you my general thesis. My general thesis is that at the end of 2018, let's say at the end of 2017, the global economy started to slow down. 2018, 2019, Europe, America, Japan, everyone was slowing down, likely heading into a recession. Then we were knocked over by the COVID crisis. Then perhaps more variants, further body blows. Now, again, in Europe, there's another crisis, and it's one crisis after another. And I believe possibly this one will be one too many. And what I'm relying on here are the early warning indicators of systemic banking crisis that the Bank for International Settlements puts out every quarter. And they've got 5 of them. We can go over 4 of them. But going over the most recent results, which are through December of 2021, basically the best possible picture, right? Because things started to turn down in March of this year, 2022, and they have only gotten worse since then. And you tell me if you think they're going to continue to get worse, but I feel that they are consumer price increases will continue, making it difficult for households and corporations to be able to earn real euros and other currencies, of course, and service the debt, the private debt, the dues that some of these countries already had too much of. That'll lead to protests from labor unions, governments trying to meet their demands. Perhaps if there is a systemic banking crisis, they'll have to take on the debt from the private sector onto their own balance sheet. We've seen recently, earlier this year, how the spreads between the core of the Eurozone and the periphery widened. Would we see that again? Will the ECB be able to step in and control those spreads with more than just words? Because in June, of course, they came out and they said some words, they made some plans that seemed all very much up in the clouds. You can tell me what you thought of them. I had a hard time understanding them and deciphering them, even though they were translated into English. And so I'm worried, I'm concerned, I'm raising the possibility that should there be a crisis in Sweden, Switzerland, France, even Germany and Spain, that this could tip over into a phased transition where we see governments implement capital controls.
That's a very, really tricky scenario to grasp for now, but I think you're absolutely right that we're headed towards an extreme winter in Europe. So let me just address a couple of the questions that you asked me. First of all, on inflation in Europe. I think it's crystal clear by now that inflation will be running even hotter in the fourth quarter of the year. The reason is that the energy price increases that we've seen in both natural gas markets, but also electricity markets, they will hit the consumer and the corporate sector with a time lag, because that's how the spot price translates into the actual bill received by households and corporates. It takes time for the spot price to actually end up at the bill paid by households and corporates. So the only question that we need to answer now is who's going to pay the bill, because the bill is certainly there. Either the public sector will have to pay it. That's, of course, a feasible scenario as well, or else you will allow households and corporates to pay it. And I think it would be very tricky for politicians to sell that story to voters, basically. So ultimately,
to households.
Yeah.
Yes, I agree, because unfortunately for politicians, households are the voters. So you can't pass the costs on to them. And I know in Spain, they implemented, I believe it was a windfall profits tax on the energy and banking system, similarly to what happened in Hungary. All that happened earlier this summer. And I can imagine it's going to get worse. I heard that Gazprom announced that their pipeline is undergoing maintenance, and that by the time they fix it in early September, there'll be 20% of capacity will be passing through the pipeline. So I can imagine prices will be even higher. And will the cost be saddled on the corporates? Will they want to move money out of Europe so as to not pay those higher taxes? Or the wealthy, will the wealthy also want to move? I just love that line you made about someone's going to pay. The households, the wealthy, corporations, the public sector, maybe foreigners. And I think it's going to be a scramble by these different components of the economy to figure out who's going to pay. And that scramble might mean leaving the Eurozone, or not, Sweden, etc., just leaving Europe in general.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
So let me throw in a couple of numbers from Germany, so the biggest economy in Europe. If we look at the situation around natural gas and the storage facilities in Germany around natural gas, the current situation is that Germany is actually building up storage, but that's the usual seasonal pattern this time of year. The question is whether the storage is big enough to get through the winter season if the flow situation worsens even more than what we've already seen. Right now, I would argue that the Germans need a relatively mild winter to get through the winter without having to basically ration gas because they will run out of it. If we get a mild winter, they will probably make it through the winter season without having to ration gas, but they are basically in the hands of the weather right now. That's a really bad scenario. Secondly, the cost of the current gas flow is out of the stratosphere, basically. If you look at it as a percent of the gross domestic product in Germany, I think the energy bill will end up in between 15 and 20% of the gross domestic product of 2022. Someone will have to take that bill. And if the public sector takes on that bill, it will have to run a deficit of, say 15 to 20% of GDP. So we will need to add new debt on top of already existing debt in Europe to solve this situation, which may make matters worse for the metrics you just mentioned from Bank of International Settlements. So why don't we move the focus to those exact metrics? So what do they showcase, and why is it important to look at them?
It's important to look at them because private debt is more volatile than public debt. So everyone knows about Italy's terrible public debt situation, but most people don't know that in terms of private debt, they've been deleveraging for a long time, and their private debt is nowhere near as high as some other countries, specifically France. Private debt, much more volatile because European corporations can't tax the public, they can't issue new currency, whereas the governments can. So the government debt, even though it's crazy, even though it's unbelievable worldwide, it seems more stable, and more importantly, it's more liquid. That's something that Jeff Snyder and I discuss all the time on our Eurodollar University show. It's not so much the creditworthiness of these countries. The United States is terribly in debt. It's the liquidity that's so welcome, so important with these instruments. So the sovereign debt, not a focus of systemic banking crisis, whereas the private one, if it gets too big, too much, too fast, can't be serviced, that can lead to a systemic banking crisis. And so the BIS puts together data on private, non-financial corporations, and the recent tally is through December 2021. And I've got a list here of countries that have still have more private debt as a percentage of GDP at the end of 2021 than they did in December of 2019. So some countries have done a fantastic job of, yes, they had a surge in private debt because GDP fell down terribly during the COVID crisis, but then they've come back deleveraged. Those countries, Denmark, Finland, Norway, these countries have less debt today than they did in 2019 as a percentage of GDP. And I'm referring, of course, always to private debt. But there are countries that have more today than December 21, than they did in December 2019. And it's only going to get worse. Sweden, Switzerland, France, Belgium, Portugal, Spain, the UK, Austria, Germany, Greece, Italy, Russia, and Hungary have all more. Now, because we have that COVID crisis, it could be a big mess, right? How do we look at this data? Can we really just compare 2 years? Maybe we needed more time to recover from that bizarre, strange crisis. If you look at it over a 5-year period, the countries that still have more debt as a percentage of GDP and have more than 150% of debt, private debt to GDP, Sweden, France, and Switzerland. I know Switzerland might not count because it's an advanced economy money center, but other advanced economy money centers such as Luxembourg, and I say we can include Ireland, I suppose, Belgium, Singapore, they've done better. The only advanced economy money center that has done worse than Switzerland has been Hong Kong in terms of debt load. So those are countries going into the crisis with growing piles of private debt. So that's just one measure. Another measure, similar in nature, but looking at it from a slightly different perspective, is not measuring the level per se, because I mentioned earlier, 150% debt to GDP. Maybe some countries can handle that better than others, advanced economies versus emerging markets. So what the BIS does is it looks at credit gaps relative to that country's long-term trend. So it doesn't care what level it's at. It's just saying, have you taken on a lot of private debt over a short period of time? Have you broken past your long-term trend. Countries that have triggered that warning: Switzerland, France, Germany, Norway, Luxembourg. Now, Norway and Luxembourg, they should get a get out of jail free card because they only experienced that spike during the COVID crisis. So we can explain that away. But France, Germany, and Switzerland, they all have a higher credit gap today than they did in 2019, and they've triggered that warning. If you look at just the debt service ratio, so how much income does a country generate, and how does that enable it to service both the interest payments and the amortization? Obviously, this would be a warning should be interest rates keep rising. Now, before I give the surprise as to which countries have triggered the BIS early warning indicator, Andreas, let me ask you, is the ECB intent on raising its interest rates further and further into this winter in order to combat inflation, which is due to oil shocks and natural gas prices? Are they going to do that? You tell me.
Well, I think there are two answers to that question. The first answer is yes, because I mean, they only have an inflation mandate.
Okay.
But of course, there is also like an indirect mandate, which is to keep the euro glued together. And the question here is whether they can keep on hiking interest rates into a recession without compromising the stability of the Eurozone. And I think that's a very tricky question to answer right now because it ultimately depends on the severity of the crisis. But I think they will go ahead and hike the next couple of meetings. The key question is whether they can hike into the recession as they intend on doing. So the German member of the ECB board, Isabel Schnabel, she basically told us at Jackson Hole, I don't care whether there's a recession. We need to hike interest rates to bring inflation back, no matter what. But ultimately, she will be tested on that thesis, I think.
It's wild. It's crazy. I say it's crazy, but I suppose that's not the topic of our show here. If they continue to keep raising those interest rates, obviously the debt service costs should increase, putting even more pressure on the private sector, on the households, on the private corporations to service their debts. Which countries in Europe have a higher debt service ratio today than they did at the end of 2019, and therefore we can expect to have even higher debt service costs in the year ahead? Spain, Hungary, Portugal, Germany, and Italy. However, ladies and gentlemen, and dear Andreas, don't worry about those countries, because again, it's a comparison of your long-term history and whether or not you are ahead of that long-term history. So each of those countries, those 5 countries I just mentioned right now, they're servicing more debt today than in 2019, but they're nowhere near previous highs that they had experienced that were anywhere near a crisis. Countries that are at their historic highs, and we would expect rates to continue to increase. Switzerland, this is their 4th highest reading in the data series that goes back to 1999. Their debt service ratio is 19.5%. France, the 5th highest ever reading, they're at 20.8%. Sweden, this one is the one that worries us. And Andreas, we should not let them off the hook. Sweden, 2nd highest of the 32 countries sample here of the BIS, they're at 26.6%. So they're at the 2nd highest level of all the countries that the BIS is tracking. And this is the highest score they have on record heading into 2022. Now, Andreas, you tell me, should we be worried? You're right there in Denmark, your neighbor, Sweden. Do they have too much debt? Have you heard something in the news, in the financial media, in the press?
I mean, I live like 30 minutes from the Swedish border, so I visit Sweden quite often. And you're absolutely right that if you look at a country like Sweden, the amount of public debt is very low relative to other countries around the globe, but the amount of private debt relative to the size of the economy is humongous. And on top of that, the regular Swedish household usually takes out a mortgage loan with a fixed payment of between 1 and 3 years, maybe 5 years at the max. So that's sort of the fixing risk of the average mortgage. While in Denmark, where I'm from, the average fixing is much longer, maybe plus 10 years actually. I have a 30-year fixing actually. So I mean, from an interest rate sensitivity perspective, that matters a whole lot, because when interest rates are on the rise, it will matter to Swedish markets much before it will matter to Danish markets as a consequence of this very short maturity of the fixings in Swedish mortgages. So it's kind of scary that already before we entered 2022, the debt servicing costs were high in a relative context in Sweden, because interest rates have been on the rise on mortgages since. So scary stuff.
The BIS breaks out household debt servicing costs for a handful of countries. They only have got, I think it's 17 countries that they do this for. For the other sample, we were looking at households and corporations. And exactly what you said is absolutely true. Sweden again comes out that right now they have the highest debt servicing ratio for households in their series history at 12%. They were the only redeeming factor is that they fell just short of triggering that BIS warning line, that line in the sand. They were just decimal points short. So I don't know if we should keep them on. It's on the radar for sure. Just because they missed that mark doesn't mean we should ignore it. The ratio is higher in December 2021 than it was December 2019. And of course, now they're on verge of triggering it as they enter this year, which no doubt they will. So Sweden, many people don't think of it, but I would think that it should be on the radar of concern.
It definitely should. I tend to agree that the interest rate sensitivity of the Swedish economy is probably the worst in the world, or at least up there. But I mean, Emil, we're talking a lot about the liability side here. There is obviously an asset side of this equation as well. If you take the Danish and the Swedish system, there's a huge pension fund system, so a public pension fund system with a load of assets in it. So if you take my private example, I hold a humongous amount of private debt. I mean, I've levered my income 5.5 times, something like that, to buy a home. But I also have assets that I can point to further out in the future in my pension fund scheme. So what do you make of that difference between the liability and the asset side of this discussion?
Let's see if I can answer I would like to answer it in two ways. One, via what the BIS did look at asset prices in households, specifically residential property. And they said, if it gets too far ahead, this signals that there may be a crisis taking place. So they're looking at the asset side over there. And then the second view I'd like to say is those public pensions, I think, might be rated by the government should these crises tip over, should the euro continue to fall, should the currencies continue to fall against the dollar, should money start to escape Europe. I am worried that these public pensions will be forced to purchase government debts as they were in the 2008 crisis. But let me first answer with the BIS. The BIS took a look at residential property prices. They have an index for a number of countries that goes back, I don't know how many years, many, many years, but they set 2010 as the baseline. And they said, all right, that's worth 100. And the European countries that have the most residential price appreciation, property price appreciation, Estonia, who would have thought that? They're at 198. Just to give a perspective, the Euro area as a whole is at 118, but Estonia, 198. Then comes Iceland, Luxembourg, Hungary, Latvia, Austria, Sweden, again, Sweden, Czech Republic, Germany, 159 versus the 100 in 2010. And then Lithuania. Now, of all of those, it's the Czech Republic that, believe it or not, hopefully there's an expert on and they can comment in the comment section, or perhaps it's the Czech Republic that seems to stand out. I don't know exactly why, but prices have already turned down based on the most recent reading, which is as of March 2022. They're well above the euro average at 163 on the index. These are real inflation-adjusted property prices. They've triggered, of course, the total household, the private sector debt service ratio because of this, the Czech Republic has. The only good news for them is they have a very low level of debt in the Czech Republic. So maybe this will cause some sort of trouble in the Czech Republic. I'm not sure if it does. The government seems to have a lot of room and space to be able to take on this crisis. That's the household sector asset price that I can answer you. The other part that I'm worried about, as I answered in the beginning, is that I'm worried that if this crisis develops, that maybe governments will be forcing these pension funds to take on the government debts.
I mean, we've seen that before, namely in Sweden, the country in question. I think we need to go back 2 or 3 decades to find scenarios where the government actually seized parts of the holdings in the Swedish pension funds. So it is a feasible scenario. In like tail scenarios, it is a feasible scenario.
I know it happened. In the global financial crisis in France, in Spain, where the government suggested very politely that these pension funds start buying government debt, and they did. And no doubt that's something that's going to happen should this develop into a full-blown currency crisis.
Yeah, definitely. I think you're right, Emil. If we look at the housing market in Europe, you obviously point to this very rapid increase in housing prices since 2010, and maybe in particular since 2020, actually. I think right about every European real estate market rallied like crazy during COVID, as was the case more or less around the globe. But we should remember that the housing market is the actual collateral that the banking system holds against this private debt in households. So should we get a landslide in these asset prices, it's a big issue for the banks.
There has been a turn down in Lithuania, in Spain, and the Czech Republic. These are the countries that have triggered that BIS early warning indicator. In the Netherlands, which has triggered that concerning line of too much house appreciation in a too short a time span, prices have not turned down yet. So those are the 4 countries that, at least by this measure, is of some concern. The Netherlands, you normally don't hear about that country and that sort of boom, or have you? Maybe I'm too far away. Have you heard anything about Netherlands housing prices?
Well, I mean, if you look at the monthly data published by local statistical offices around Europe, I think most countries have now seen a sort of a reversal of the trend from 2020 and 2021 during June, July, and the early parts of August. In the worst case scenario, Sweden is an example of that. We've seen a price depreciation of around 10 to 12%. In sort of prime locations for housing. So it's starting. I think that's a natural consequence of higher mortgage rates. So it's starting to sort of flow around in various countries in Europe, this price depreciation of real estate. But Emil, I wanted to ask you, I mean, if we look at these warning signals from the Bank of International Settlements, and if we assume that the asset side is starting to roll over at least, or at least we will see a pause, at the very least, see a pause in the appreciation trends. What do you make of the sort of systemic risks surrounding such a scenario with very high private debt and a potentially sliding asset side?
I would believe that the European Union needs to keep the euro together, so they're not going to give up on the euro. But as I keep reinforcing, I think the idea is that if asset prices slide, if this recession continues for some unknown period of time into the next following year, if politicians who are more nationalistic come into power as people look for answers, I would think that the powers that be in Brussels, in Frankfurt, try to keep everything together by allowing countries to guarantee private credit, as we saw during the COVID crisis. Now, this is a thesis that has been put together so eloquently by Russell Napier. And so I am completely 100% stealing his work here. So yes, please don't write him and tell him that I'm stealing his work. He already knows I am. But his thesis is that the governments must keep the project together. They also want to get reelected. And therefore, the easiest way out of this crisis with the least volatility, not that it's going to be easy, in any sense, but most easy, would be to guarantee bank lending, much as we've seen in Japan during their heyday and China in present day, that sort of window guidance. They commandeer the banking system and inform the banking system, lend money to this sector, lend money to this voting public. And I believe that would be the next big thing. But of course, that comes with costs. And there will be a whole host of restrictions and financial repression, as Russell Napier calls it, that comes along with this. And the key is that there will be losses in real terms for asset holders. So that's, again, why I'm thinking that maybe the loss in the euro says more than just recession, but is the early trickling of capital flight, perhaps. What do you think of that thesis?
Well, I think it sounds like a feasible thesis. As I mentioned initially when we debated the energy crisis, I think the most feasible scenario and maybe the most politically palatable scenario is for the public sector to ultimately decide to take the bill and basically withdraw the burden from households and corporations as a consequence of this supply side crisis in Europe. And by the end of the day, if they decide to go ahead and pay the bill on behalf of households and corporations and to guarantee maybe further debt to service already existing debt, then we will have a whole new scenario for European fiscal policy to look into, because we've been used to a very sort of constrained fiscal policy set up in Europe over the past 10 years, a European central bank being the easy sort of part of the policy mix here. And right now it's kind of upside down, as the German politicians will have to take a bill of 15 to 20% of GDP. Other countries around Europe will have to take a similar bill, which means that more public debt will have to be serviced, basically. And I think that was the sort of initial catalyst of the inflation pressure that we see right now in Europe and also in the US, that the public sector started to multiply the easy monetary policy. So if we go down this road and the policymakers in Europe will decide to guarantee that and to pay the bill for the households and the corporations when it comes to these high interest rates and these high electricity costs and these higher natural gas costs, then they will basically just postpone the inflation picture into next year and to the year after.
That's the key, but I want to make sure that it's the guaranteeing of the private sector, that it'll be the banking system that they're guaranteeing the loans by the banking system. Because as Jeff and I often talk about on the show, we're not fans of central bank quantitative easing in terms of generating economic activity or inflation. We don't believe it creates either. We believe that they create bank reserves that then sit idle on bank balance sheets, because the banks think that it is too risky to lend out there. And right now it does seem absolutely too risky to do so. That's why I believe it would take politicians strong-arming these banks, commandeering them, informing them that they must, as a national security issue, as an emergency to the cost of living issue, that they must issue the credit and the loans into the private sector. And that's what will get liquidity into the system. Quantitative easing isn't really liquidity for the economy. It's liquidity for the banking system that doesn't want anymore. If you want liquidity for the economy, you've got to get banks to lend. They won't, because it's too risky. The politicians have to step in and guarantee the lending. It happened during COVID, and I am shocked that they didn't continue doing it. I thought politicians would be thrilled to be able to finance and spend money to their voting constituency and not have it on the books. Although I hear that more recently, some countries, that a lot of the lending has been guaranteed by governments. That's still developing. But anyway, that's what I'm on the lookout for. Private lending guaranteed by the government.
So what will be the sort of medium-term ramifications of such a policy move?
Medium term, I would think that it would result in the private sector wanting to take out more debt if it's guaranteed. But as we've just discussed, we've got too much private debt already. Therefore, governments will be in the position of determining and allocating who gets the credit in Europe, which will be completely different than the market forces that we're used to. It'll be politicians that'll only be allowing credit to be going to socially acceptable causes, not to financial engineering, for example. That's what I think, that'll be a big change in the medium term. I'm really thinking phase transition out of the same old way we've been operating for the last 15 years. If there is to be a giant transformation to break out of the doldrums that we've been in, we'll have a new monetary order, a new monetary system that won't operate the way it has been before.
Yep. And maybe COVID was the sort of initial catalyst of all of this happening. At least it was sort of the outset for the whole discussion on whether to guarantee private debt to a much larger extent than what we've already seen in the Eurozone, because it happened in right about every country in Europe during COVID. And if you're right, it will happen again as a consequence of the ongoing electricity and energy crisis. As the ultimate thing, Emil, I basically want to discuss whether this is a tradable thesis. And one thing we could debate in that relation is whether this BIS early warning signals setup is something that has worked before. What's the track record of this BIS setup?
Well, the BIS, they know what they're doing. And so they say that historically, these early warning indicators have a very good ratio of ignoring the false positives. So there are some false positives, but on the whole, they find that there's a 50% chance of a banking crisis within 3 years of triggering one of these early warning indicators. So that's pretty good. Just for your run-of-the-mill, any old country in any old year, the chance of a financial crisis is 7%, just on average. So 50% seems very good for a 3-year outlook. And just to follow up what you were saying there, it's not only the COVID crisis, not only the cost of living crisis brought on by the cost of natural gas and energy, but at the same time, we have problems with China, perhaps deglobalization. I know that Germany has been making strong statements that they don't quite care for the way that China has been operating and conducting their foreign policy, and siding with, or not siding with, the European cause and liberalism. And there have been some strong statements out of Germany that their economy has been taken advantage of by China. So I see that's another crisis in the offing, yet another one. All of it pushing towards a break with the system that we're existing in.
Yeah, I think you're absolutely right, Emil. Let's for a second also look at other regions worldwide, because one thing is that these early warning signals have been triggered in Europe. But as an asset allocator or as an investor, I would like to know whether things are worse in Europe than they are in the US or in Asia. So is this situation with too much private debt also an issue elsewhere?
It is an issue, surprisingly, just starting to with the United States. The United States just triggered the real residential price gap early warning indicator. What a mouthful. They've got to come up with a better name for these things, but they just triggered that. Australia just triggered it right now, both of them as of March 2021. And you may be wondering, wait a minute, Australia's housing market is crazy. Again, it's relative to its long-term trend. So they've been crazy for a long time, and they're used to it. Now it's gotten beyond the pale. But if I was to pick 2 countries outside of Europe that stand out, that are on par with, let's say, France, perhaps Sweden, Canada and South Korea. And South Korea, I would say, is leading the pack. They have rung in every single early warning indicator by the BIS. Their ratios are not improving. Even though the global economy improved, even though GDP improved, their private debt continues to rise and outpace what the GDP is doing. So South Korea looks to be perhaps the first country that may trigger a crisis. Canada is not far behind as well.
So now we know who's worst in class. Who's best in class, Emil?
You've got me there. You've caught me. I don't know who is best in class. I would say it's emerging markets. In terms of private debt, they haven't put on very much relative to their GDP in the long run trend. But of course, the emerging market problems are that they have currencies that are reacting to the dollar. And no doubt, as we enter this crisis, the US dollar will continue to keep rising. So that'll be a loss there. So somehow we have to find a country with low levels of private debt and is not a currency risk. And perhaps I'm talking my book, perhaps this is self-serving. Dare I say the Cayman Islands? Yes, where I'm located. How about you, Andreas? What do you think? Which countries out there look to be in good shape? They're all in terrible shape. It's just varying degrees, but maybe I've missed some. Which ones look better than the rest on your radar?
It's not easy to find them, and that's sort of the tricky part of this equation, because it's very easy to find those countries doing really bad on these metrics. So I think what you need to look for is basically countries doing less bad but still bad in this relative equation. And I actually think that you can find a few decent picks in LATAM. So Mexico and Brazil could be decent picks as longs versus some of the countries mentioned, for example, Canada, South Korea, and Europe in general. So I think my top pick right now would be Mexico. Decent balance sheet, decent. And from a currency perspective, also decently shielded against the current turmoil, as they have decent terms of trade. Brazil is another example of that, a country with decent terms of trade, given all of the turmoil ongoing in food prices, energy prices, and stuff like that. So maybe that's my answer to that question. A couple of countries in Latin America.
I love it, especially Mexico, which could theoretically, their narrative says, should benefit, at least from the United States and perhaps Canada, moving some of its supply chains into a more safer, away from China, away from across the Pacific location. So that makes sense to me.
Ultimately,
Gold too, Andreas. I know that's not a country, but maybe it should be. It's been around for so many years. Gold, not the worst place to be either. As soon as real rates start falling, which I could see happening in not too distant future at all, gold should do well.
Yeah, would tend to agree. But now that we have an expert in the Eurodollar system with us, Emil, I ultimately also want to touch upon the signals being sent by the Eurodollar curve, because it kind of rhymes with what we're already saying, that there is a potential crisis brewing, right? We have a massively inverted Eurodollar curve, something that we've seen before, for example, ahead of the 2008 crisis. So what do you make of the current curvature of the Eurodollar curve in relation to this debate on private debt?
The Eurodollar curve first inverted in December 1st, 2021, warning us that once again, this amazing, gigantic market, a collection of independent forecasts from around the world, believed the balance of probabilities was that the central bank, the United States Federal Reserve, will be lowering rates sooner than later, at least relative to long history. And that inversion kept getting closer and closer as the months moved forward. And basically, it's the same message as the US Treasury curve, which is the more famous bond market inversion, signaling that many independent analysts believe that something is coming closer and closer that will force the Fed to pivot away from their quote-unquote hawkish rate increases. So that's what the Eurodollar curve is saying. But it inverted in December 1st, right, 2021. But it had been flattening since October of 2021, when things in the economy began to slow down. Things stopped looking as rosy. And then it had stopped expanding earlier in the year. Same thing with the US Treasury market. And for the audience that's watching, that's one of the key messages I want to give them from this presentation. It's not the central banks that are hiking rates and therefore slowing the economy down. These two markets, the bond market, the Eurodollar futures market, stopped believing in the COVID recovery early, at least mid 2021, and then they started betting on a slowdown in late 2021, and they've been betting heavier and heavier. And now we can all see that it is indeed on its way.
Yeah.
Well before hikes by the central banks.
So I guess the final conclusion here, Emil, is that you need to be on the watch over the coming 2 to 3 quarters, or maybe even the next year or two, as a consequence of the signals sent by the Eurodollar curve, but also these early warning signals from the Bank of International Settlements. It was a great pleasure to talk to you, Emil. Thank you so much for joining us and talking to this point of early warning signals from the Bank of International Settlements.
Andreas, there are 2 hosts on this show right now, but you're the better one. This was fantastic. It was very easy. I appreciated you holding my hand all the way through. Great, great. Thank you very much.
Thank you so much, Emil. What an interesting and refreshing perspective on the ongoing crisis in Europe. Not only is Europe battling an energy crisis right now, but the fundamentals heading into this crisis were also very bad. If you look at the private debt load in Europe, it was already immense before we entered this current energy crisis. And basically, no matter who's going to pay the bill this winter in Europe, it will only lead to an increasing debt load across the continent. To name a few of the worst examples of private debt in Europe, countries like France and Sweden score relatively bad on these early warning signals by the Bank of International Settlements. So watch out for those countries, given that interest rates are on the rise. If we look at the private debt load across other regions, Emil basically mentioned a few of the worst examples being Canada and South Korea. So you should probably also be on the watch for a potential crisis in those countries should interest rates continue to explode to the upside. So by the end of the day, the risk of a more structural crisis due to increasing debt loads has increased, and it is also what the early warning signals from the Bank of International Settlements are telling us. So in your portfolio, you should probably look for countries with a relatively decent amount of private debt and a relatively stable currency environment, given the ongoing turmoil in energy markets and so on. My best pick right now would probably be Mexico, as the private debt load is not as bad as seen as elsewhere. And secondly, the foreign exchange rate in Mexico could gain from the positive developments in the terms of trade for Mexico, given the ongoing energy and food crisis. So Latin America could be the pick when we assess the world from a private debt perspective.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.